Hey everybody, Boris this week at Forex. Welcome to the weekly technicals for the commodity dollars for Aussie dollar, dollar CAD, and Kiwi dollar, October 8th to October 12th, 2018. And I think the big story this week in commodity dollars is just the horrible hit that Aussie and Kiwi took on the rates. The caddy story, of course, is very different because now we have the NAFTA negotiation adhered to. So that was a big positive beginning of the week, and it really gave it an superb existential boost to the CAD. Was something we've been talking about. That the two big trade stories, Brexit and NAFTA, one of them got resolved. Certainly was positive for CAD. Took it all the way down to 128, and it's being supported also by strong oil, by very decent economic data. So all things being equal, Canada definitely still remains the superb choice amongst all the commodity dollars. But what was fascinating was just a brutal hit that both Aussie and Kiwi took to the bottom line this week as the ranges really moved down. The range in Aussie now comes down to really 70 as the key support level. Caddy now is at 31.28, moved down a little bit. Had a little bit of a bounce back today, even though data was quite good. But I think the other big story, the surprising story, was just the annihilation of Kiwi that took out this long-term support. You know, we talked about the idea that it looked like the commodity dollars were basing. Well, that notion got just battered to smithereens this week as all those bases completely shot to bits as the week progressed. The data this week really has almost nothing on the commodity front. Not almost nothing, but just virtually nothing. We just have business manufacturing PMI out of Kiwi, and that's it. So very quiet on the echo data front. But as far as just charts go, let's take a look. And we'll start with Kiwi, which I think got battered the most. I mean, look at this. It's essentially like a free fall that takes out all of the support that we had here at the 65s and just falls by the wayside. And it's also a very good example. I think, you know, we talked about the idea how sometimes when I say, hey, I'm not ready to trade this until and unless it takes out these levels. And that's a great example of why. Because the markets are going to be indeterminate, but once they take out key support resistance levels, the continuation tends to be much firmer and much stronger. The confidence in the continuation from this move was definitely very strong. So yield stories definitely were the big factor. Risk off stories also, I think, having a big impact, and they may have even more of an impact, I think, as the market may be coming to the realization that, as I said, peak growth in the U.S. has happened. China is going to be under a tremendous amount of pressure because of trade wars. And all of those things are going to start taking their toll as global growth now begins to slow down significantly. This sort of benign, synchronized growth across the world scenario is getting shot to smithereens. And I think what you're seeing first and foremost is the comm dollars take the hit off that realization. So you now absolutely abandon the whole double bottom theory in Kiwi dollar. If we look further, we really have to go out here on the weekly scale. It's actually, let me just get down. It's really quite a far away support, but it's basically around 63.50. So it's not too far away as far as finding a bottom here, but it's a sharp decline. Also, look at this. This is a weekly candle. That's a massive for Kiwi, which is a very low volatility pair. This kind of large volatility move is always indicative of at least some continuation. Now, the large volatility move here happens to be at the end of a massive decline. So how much more do we have to go? I would say I probably would want to be more of a buyer than a seller once we start coming down into 63, 62s, because we're at the lower end of this very long sell-off cycle. But it doesn't mean that from here to there's still not room. And I think it feels like the swing low here is 63.50, but the true support is around 62. So from here to there is still about a couple hundred points, and certainly more possibility to the downside. We could have a little bit of a bounce back, but right now Kiwi becomes very much a sell the rally trade all the way up to the upper end of this range, which is 66.50. If this candle gets completely engulfed to the upside, that's a big reversal, big fake out to the downside. But I really think that there's at least 50 to maybe 70 points of continuation at minimum here in Kiwi, as the momentum just seems to be way too strong in this particular pair. On the Aussie side, also big decline, and 70 is a big psychological psychological level, though not really a great technical level. You can see that there's some support here at 69 and some support here at 68. So the 68-69 corridor is the true technical support, but the psychological support is going to be at around the 70 level. So we're going to be watching that carefully just to see how much of a bust it'll be. I would say if we do go to the downside, probably 69.50 is going to be the washout level for the Aussie for the near term. A lot of it is going to depend on just how severe the sell-off in equities is. Ironically enough, the drive in Kiwi and in Aussie is not going to be equity prices, because if we get into this sort of massive risk off sentiment, and remember, it's October. This is really the time. If we're going to have any kind of a correction in the equity market, and we've been way too complacent, this is going to be the time to have it. And the correction could be vicious. We could have 5%, 7% pull down. All of this is going to play its way through Aussie yen, Kiwi yen, and certainly pressure the calm dollars to the downside. Now, dollar CAD stands alone and apart from that story because obviously it has a much more positive story by itself, but it's not immune to risk-off flows. It's just simply, I think, going to be much more muted. So here, the trade up probably goes to 130, maybe 130.50 as the maximum risk-off flows in dollar CAD. Still, we'll talk about this in the crosses, but still the cleanest, clearest trade has been to essentially, on a long-term basis, to trade CAD against the other commodity dollars to the long side. So CAD not trying to make its way back up towards the 130. The data still was not bad, as I said. It's just simply, I think, getting some risk-off flows. But overall, dollar CAD is in a longer-term decline here with a series of lower lows. Really, the only way I would change my mind on this, and it's possible if for nothing else than just simply risk-off flows. In other words, dollar CAD could rally significantly, even if Canadian data is strong, even if BOC hints at possible further tightening, if the sell-off in equities just becomes massive. I think that's that's really going to be the story of the week from the commodity dollar land and from risk-off trades, because we don't have that much stuff on the economic calendar. Most of the political stuff now is gone. And it's really going to be a question of, if equity investors start to panic and start to believe in a global synchronized slowdown, this is going to start to develop in the currency market through the commodity dollars as a major sell-off. So I'll be watching all of that as the week develops.